We're going to go into Fort Knox to make sure the gold is there.
Are they going to?
You know that we're going to go into Fort Knox. Do you know about that?
Careful, Mr. President. Get to meddling with gold, you might get more turbulence than you were expecting. Gold seems to be finally having its media attention moment in the 21st century bullion bull market. The U.S. President Donald Trump went on tour this week, hammering home that he's headed to Fort Knox to see part of the nation's still world-leading official gold reserve stockpile.
That was a bad bump.
Are they going to eliminate more national security positions, civilians there?
We'll see what happens. But one of the things we do want to look, I mean, we hope everything's fine with Fort Knox, but we're going to go to Fort Knox, the fabled Fort Knox, to make sure the gold is there.
Where would the gold have gone?
If the gold isn't there, we're going to be very upset.
Instead of another silly press tour at Fort Knox and then pretending that it's some kind of audit, to actually do the job correctly, the U.S. would need 4 parties of simultaneous auditing teams who would spend days, possibly weeks, counting and testing at random samples from the 4 supposed locations of our U.S. official gold reserves. You would need teams in Fort Knox, Denver, West Point, and at the New York Federal Reserve. You'd probably also have to declare by fiat any potential encumbrances on said gold reserves are null and void, come what may. But sober up, everyone. A legit U.S. gold audit is highly unlikely to happen, and I'll go as far as to say not within my lifetime it won't. After all, our now U.S. President told us all in 2016, quote, "We don't have the gold. Other places have the gold." And I'm going to show you that why later. But for now, have a listen again.
Envision a scenario that this country ever goes back to the gold standard.
You know, there's something very nice about having something solid. You know, we used to have a very, very solid country because it was based on a gold standard. We don't have that anymore. There is something very nice about the concept of that. It would be very, very hard to do at this point, and one of the problems is we don't have the gold. Other places have the gold.
In case you forgot or were gold asleep at the time, only a few months following that clip from Trump on the campaign trail in Utah, he shockingly won his first term as U.S. President in early November 2016. The 24-hour period that followed his win is still the most obvious short-term global gold price intervention to date. An up and down $100 an ounce swing, when to start the election night, gold was priced around $1,280 an ounce. That's like seeing a $250 an ounce swing in a 24-hour period with today's gold price near $3,000 an ounce. Not impossible, but many standard deviations from normality.
We're actually going to Fort Knox because I want to see, do we have the gold? Do we still have whatever it is, tons of gold? I hope we do. Wouldn't that be disappointing? Fort Knox. You grow up hearing about Fort Knox. You can't get in. You can't even see it. Nobody sees it. You go there and the place is dry. Would that be terrible? I'm going to do something. I'm actually going on this one. You know, all my life I've heard about Fort Knox. That's where the gold is kept, right? I heard Fort Knox. Oh. But, you know, we're getting a little bit shaky. We're getting the yips on this stuff. Like, I want to find out. So we're going to open up the doors. I'm going to see if we have gold there. We want to find out. Did anybody steal the gold in Fort Knox? It's a pretty amazing place. But I'm going to actually go. We're going to open the doors. We're going to inspect Fort Knox. We want to make sure that we actually have, you know, 400 tons of gold or whatever the hell it is. It's a lot of gold. I don't want to open it and the cupboards are bare. Could happen.
Okay, let's move on and kill a bit more recent gold hopium. Treasury Secretary Scott Bessent was asked this week about his administration's plans for gold. Here's what he had to say.
One thing potentially that could happen, and people are questioning it, is maybe remarking gold. Elon Musk, who's leading Doge, was talking about maybe going to Fort Knox to make sure those gold reserves are there. That comes under your purview. Do you have any plans to visit Kentucky?
I don't have any plans. I can tell you that we do an audit every year. I can tell the American people on camera right now that there was a report September 30th, 2024. All the gold is there. Any U.S. senator who wants to come and visit it can arrange a visit through our office.
Gold was your biggest holding when you were a hedge fund manager before you divested to become the Treasury Secretary. So you know the value of where gold is right now versus where it's marked on its balance sheet, just north of $40 an ounce. It's close to $3,000. Is it under consideration for this administration to revalue gold?
I think that somehow when we were talking about the sovereign wealth fund and I said monetize the balance sheet, I can promise you that's not what I had in mind.
So it's not under consideration, not on the table?
That's not what I had in mind.
Have to ask you, sir, the question that everybody wants to know from the Treasury Department. Is there actually still gold in Fort Knox?
We do an audit every year, so the audit that ended the year September 30th, 2024, all the gold is present and accounted for.
Okay, because this is something that people are apparently very concerned about. Elon Musk has been promising to verify that the gold is still there.
And I would invite any of the senators, especially your home state senator, Ron Johnson, who I'm a big fan of, that any senator, they call the Treasury, we're happy to arrange a visit, they can do an inspection.
In terms of our fiat US dollar denominated inflows into COMEX gold warehouse system, the current purchasing power of the gigantic size inflows dwarfs what happened during the 2020 COVID COMEX gold inflow arbitrage. Well, it makes sense as the spot price of gold has doubled since way back then. The typical names of the large COMEX gold house and customer accounts taking the gold inflow warehouse warrants is typical, with JP Morgan's customer account leading, Bank of America, Santander, and Barclays being the next largest, all stopping over 10,000 100-ounce equivalent COMEX gold futures contracts apiece. In terms of gold ounces, the inflows are still a bit tinier to date than what they were back in COVID 2020. And what followed from mid-2022 to the near end of 2024 was a slow bleed out and pulling of COMEX gold from the collective warehouses. Where did all that gold go? Well, perhaps some went back to London, but I'd venture to guess a good amount of it went off into high net worth private investor gold bullion stashes here in the United States. Now, to put this recent 600 gold ton inflow into the USA into perspective, that's like over 72% of the purported gold underlying the world's still largest unsecured ETF just up and moving into the COMEX system in a matter of a few months. Meanwhile, silver mostly being pulled from London into the COMEX system, it's being slept on. Silver is more dislocated than global gold market. Silver has no lender of last resort like gold does currently from central bank leasings or lendings. But more on silver market on the other side of this week's bullion market update. There were even high-ranking bullion desk officials this week asserting on Arabic language news programs that the gold outflow to the United States has been one of the largest on record, with estimates of 2,000 tons of gold, whereas up to now we only have visibility of just under a third of that bold claim. Further gold inflow visibility in the USA can be seen from this latest Swiss gold export data to the USA. Last month, there was a net inflow of 193.4 tons of Switzerland's Big Four gold refineries that went off and came to the United States. Where did that gold come from? Well, about 62 potential countries that export gold to Switzerland for refining are likely potential leads. Allow me to put this large gold inflow data into perspective through a Chinese lens over the last dozen years. Between exports from Switzerland and the United Kingdom, I can count here a net gold bullion outflow to China of over 5,300 tons between the two charts. And that only partially covers the amount of gold China has been gobbling up since the 2008 global financial crisis. Someone who's been warning about this precarious global gold market situation for about as long as I have, Luke Groman, looks like he is about to have a published long-form interview with Tucker Carlson. So millions of U.S. gold buying demographic viewers are about to get a masterclass in the world's modern-day gold market. And yes, I would say by now we can call gold's media attention phase is finally underway in full for this 21st century bullion bull market. Now let's shift gears and swing over to sneaky, seemingly lawless London. I was alerted this week that longtime London gold trader Peter Hambro's article from July 4, 2022, where he basically admitted that day-to-day precious metals prices are derivative suppressed shams, well, his Tell the Truth article recently got pulled from the London Reaction website. Yes, memory hold. No problem. You see, we have this technology called digital archiving on the World Wide Web that allows us to view past versions of people's websites. So we still have Peter Hambro's article in full, and we'll continue publishing it so people know how to prudently get bullion positioned now and not later. The situation, as admitted by the U.S. Office of Comptroller of the Currency, has gotten even more derivative levered than it was in 2022 when he published this article. In the USA, the largest precious metal derivative players remain JP Morgan, Citibank, and Bank of America in that order. Of course, we have no view of how many derivatives are offshore over in London or in other places around the world. We do have documents going back to early 2013 when the Central Bank of India at the time admitted that the then global gold market was discovering day-to-day prices through phony derivative leverage, at the time estimated to have been 92-ounce paper versus 1-ounce physical gold. It's probably gotten well worse since then, and don't even get me started how ridiculously paper-suppressed silver is, probably something like 2 to 3 multiples of what the Central Bank of India admitted in 2013. Let's swing back again to London, who earlier this week had another go to try and calm onlookers' nerves about their delaying situation in gold withdrawals from London. Have a look and listen.
We talk about gold. Look, we're surrounded by the stuff here, but obviously, other than jewellery and other forms of electronic uses, the main use for gold these days is as an asset. And there's something quite interesting going on with those assets around the world. But let's start by there's another nice bit of gold. Let's start by just reminding ourselves, where does gold actually come from? Well, a lot of it comes from out of the ground in various countries around the world, so Russia, China, the US, Canada. But after it comes out of the ground and it gets kind of minted, turned into bars and so on, often it ends up back under the ground again in vaults. And where are those vaults? Where do most people keep gold around the world? Well, it's New York and it's London. So in London, if we kind of zoom into London, underneath the Bank of England, a few floors underneath, you can actually hear the underground whirring around that level of the bank. There are all of these bars of gold, loads of gold, but it turns out some of that gold has recently been leaving London. Where's it going? Well, have a look at this. It is going from London across to New York. So it comes out of those vaults, it goes into planes, and then it flies across the Atlantic, usually in the bottom of a passenger jet. And it's actually happening, it's coming from other countries as well. So it's not just London. Everyone wants to bring gold to New York. Why? Well, have a look at this chart and you get a sense of what's going on. So this is showing you just how much gold is in various different warehouses, so commercial warehouses in New York. It was relatively steady up until the US election, and then look at this line. It went through the roof. And why is that? In part, it's because people are worried that Donald Trump is going to impose tariffs on gold being moved back into the US. So they're bringing loads of it back into New York. It's a glut, and it's not just gold, it's silver and a few other things as well. But that's a problem, back to London, that's a problem for the Bank of England. Okay, so this is the back of the Bank of England where you physically get that gold out of the vaults. And it turns out it's quite hard to do that. And that's causing some issues. We just went to the Bank of England to talk to the Governor, Andrew Bailey, about this. Here's what he had to say. Down kind of well beneath where we're sitting right now
yes.
is a lot of gold.
Yes.
But at the moment, it sounds like the bank might be having trouble getting as much gold out as people want. I mean, is that connected with what's going on around the world?
So you're sitting over, I think, about 420,000 bars of gold.
That sounds like a lot of gold.
That's quite a lot. A bit of commentary about, obviously, the time it takes to move the gold is, obviously you have to have a lot of security and a lot of, insurance around moving gold. So you can't just put it on the back of a lorry and take it away. So it has to be planned. So there are constraints. There are just very physical constraints. But we've got slots for all the gold people want to move in and out. By the way, we've got a lot of gold. In recent years, a lot of gold has come in. So gold does, not huge amounts, but gold does move in and out.
There's still plenty of gold at the Bank of England.
There's still plenty of gold at the Bank of England.
So plenty of gold still at the Bank of England, for the time being at least. But have a look at this. This is showing you how much gold there is in the New York Fed. So that's the other single biggest vault in the world. That's New York Fed. This is showing you how many bars, indeed, how much the gold there is at the Bank of England. It was climbing, as the governor was alluding to. It looked for a moment like it was going to exceed that. But in recent years, actually, that line has started to go down. And it happened long before Donald Trump came into office. People repatriating gold from London to China to India to other places. So that's down 10% since 2022. It's quite a big deal there.
You might think that with the Western world currently going nuts over gold, the Eastern world might be selling into it. Well, not exactly, based on reports like this.
This is absolutely crazy. Right now, there might not be any other asset in the world that's been snapped up like gold by central banks, global investors, businesses, and regular people all at the same time. And the key here is, they are all going after physical gold. This could be the biggest scramble for real gold we've ever seen. And with this frenzy, global gold prices just keep climbing, hitting new record highs almost every day.
According to the China Securities Journal, at 10 a.m. on February 14th, a gold store in Beijing's SKP Mall saw long lines outside right after opening. One frustrated shopper said, "I can't even squeeze into the store. The wait is at least 6 hours." Many shoppers shared similar experiences. One person said, "It's so hard to buy. The gold pieces I liked were all snatched up by the scalpers." Recent reports from various gold jewelry stores like Chow Tai Fook, Chow Sang Sang, Lao Feng Shang, Lao Miao, and Luk Fook revealed that around February 10th, gold jewelry sales were booming. A staff member at one store said daily sales during that period exceeded 100,000 yuan, much higher than usual. Bracelets, necklaces, and pendants were the most popular items. On the evening of February 8th, a store employee said, "Today, we made over 70,000 yuan in sales. Many loyal customers who didn't buy before the holiday came back after seeing prices go up again." Ms. Meng from Beijing joined the gold rush after the Lunar New Year. On February 9th, she arrived early at the mall and said there was already a dozen people in line before the doors opened. The moment the mall opened, everyone rushed straight to the gold store. The gold buying frenzy isn't limited to Beijing. Similar scenes have been reported in Shanghai, Hangzhou, and Henan province.
It's already past 8 p.m., but there are still long lines outside the gold stores.
I came here first thing when the store opened. They're handing out queue numbers. For locals, it's not too bad, but for people coming from out of town, they might have to wait all day just to get their hands on some gold. In Hangzhou, a woman named Ms. Wang spoke on camera saying, "I left Jiaxing at 5 a.m. just to join the gold buying crowd." Ms. Feng, a shopper waiting in line for jewelry, said prices have been rising too fast lately. She explained that many people follow the mindset of buying when prices go up, not buying when they fall, which has fueled the rush to buy gold. Because of the long lines, some scalpers have even started selling queue numbers for a profit. Right now, buying gold in China means waiting at least 6 hours in line. Scalpers are taking advantage of the situation, reselling spots in line at a markup. It's not just jewelry stores seeing this surge. Even the source of gold itself is under pressure. Shenzhen's Shuibei district, the country's largest and most developed gold and jewelry hub, hasn't escaped the chaos. Reporters from Daily Economic News found that parking was nearly impossible. By the afternoon, traffic was backed up and crowds kept growing. As the gold rush intensified, there was a sudden drop in international prices. On February 14th, the London spot gold price fell 1.5% on a single day, closing at $2,882 per ounce, the biggest daily drop in nearly 7 weeks. Domestic gold jewelry prices also dipped, falling to 875 yuan per gram, with some brands lowering prices by as much as 18 yuan per gram. But this price drop didn't cool the market. Instead, more people rushed to buy gold, with some waiting for 8 hours just to buy the dip. One early morning after another has turned unusual because of this gold rush. At 4 a.m., before the sun rises and with freezing winds blowing, long lines have already formed outside jewelry stores across the country. People are bundling in thick winter coats, rubbing their hands and stomping their feet to stay warm. But their eyes shine with excitement. They're not lining up for limited edition sneakers or the latest smartphone. They're here for gold. The optimistic outlook on gold's future is one of the key reasons people are holding on to their gold.
China's Spring Festival gold buying frenzy is continuing even after the holiday has ended and despite higher than normal prices. Global gold prices surpassed the $2,800 mark in February, steadying at the all-time high amid widespread worries that U.S. President Donald Trump's tariffs on Canada, China, and Mexico would fuel inflation and hinder economic growth. In the southern Chinese city of Shenzhen, gold buyers from across the country flocked to Shuibei Market on the first working day after the holiday, which ended February 4th. Many gold store owners said they didn't expect such strong demand given the rally in gold prices.
Buying gold isn't really spending money. I'm buying something that holds its value, and I can wear it too. It's a good deal.
The rising gold prices are also heating up the country's gold buyback market. At one gold store in Beijing, people were lining up to sell back their gold for cash.
I bought it around 2012 to 2013. The current price has reached our expectations.
Good on you, Chinese grandma. Nothing wrong with taking some profits after your gold has more than doubled in local spot price over the last dozen years. After all that time, something like 30,000 tons of gold have basically gone off to the Silk Road majors, with India and China leading the way, getting more gold wealthy seemingly year by year. I'll stick around. After this short break, we're going to get into the silver market and hear from recent silver commentators about when silver gets going, it will likely blow gold's recent massive moves away. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button and subscribe to our channel if you enjoy these weekly bullion market updates. And be sure to visit sdbullion.com/IRA to learn about our 3-in-1 bullion IRA solution that our customers love.
Like, oh, sir, this could take 4 to 6 weeks. Man, this process is really broken. What we've done at SD Bullion is we've taken everything under one roof. Transparent pricing, you know exactly what you're getting. All the metal comes into our facility under camera. It never leaves. If you want to sell back, if you want to take a distribution, these processes that would take you 3 to 6 weeks to do at another program, we'll ship that out in 1 to 3 days after you decide you want to do that.
The silver and gold markets finished up again on the week. The spot silver price closed at $32.55 an ounce bid, with a bit of a sell-off and weakness to end the day. The spot gold price ended today at $2,937 an ounce bid on the week's trading. The spot gold-silver ratio rose on silver weakness to close the week at a still historically high level of 90. When will we finally see silver begin playing catch-up to gold? That's still a common question, unknown, but hard to believe that gold can blow into the 3,000s per ounce this year, and silver would still have its relatively relaxed correlation and not play catch-up and even outperform gold. Staggering physical silver supply deficits have many silver commentators feeling the same. Bloomberg macro strategist Simon White wrote on silver this week, "Silver has capacity to shock as it plays catch-up with gold. Keep an eye on silver as it starts to pick up versus gold. The ratio between the two is historically low, leaving silver looking very cheap with plenty of potential upside. Silver is Scooby-Doo to gold's Scooby, more brash, volatile, and can move quicker. Gold has had some explosive moves in its history, such as in the late 1970s and around the Eurozone crisis. But both times, silver's rally was even more extreme. The prevailing reason being given for gold's rally is tariffs, causing the spread between COMEX gold, i.e. paper gold futures traded in New York, and the physical gold price set in London to widen. But I think this is a convenient narrative. The remote cause is more likely to be a shortage of deliverable physical metal in London after years of emerging market central bank hoarding. We are seeing the same dynamics with silver as we are seeing with gold. COMEX silver warehouses in the USA are filling up while stocks in London are falling. Silver often comes late to the party, but when it finally gets there, it can be an unstoppable hedonist." Daniel Gali, senior commodity strategist at TD Securities, continued banging the tables this week on silver, highlighting exploding 20-year high 3-month silver lease rates in London. He wrote, "Disruptions in silver markets are the most acute in recent history as London's, quote, free-floating inventories drain below critical thresholds for the market structure. While prices have thus far posted a remarkable performance year to date, many remain disappointed by their relative underperformance to gold. Ultimately, this is a framing bias. This strong price action has occurred despite little evidence of speculative inflows, in contrast to gold, and prices have still managed to keep up with a spectacular, quote, heads I win, tails you lose setup in the yellow metal, nonetheless. We don't think these disruptions will resolve easily, and rather think that silver markets must incentivize metal to return from unconventional sources. Markets are still sleepwalking into the silver squeeze you can buy into." Let's hear more from Daniel further as he was on Bloomberg Canada today.
Gold hitting record highs this week. Look at that, up almost 50% in the past year. Our guest says that the precious metal is gaining from both its traditional role as a safe haven, but also a hedge against currency depreciation. Let's find out more from Daniel Galley, Senior Commodity Strategist at TD Securities. Daniel, hard to know where to begin. There's more and more talk, though, that the game plan in Washington is to depreciate the U.S. currency to make U.S. exports more competitive. And of course, that would be overwhelmingly likely to be good for gold.
Yeah, you know, Andy, I think that's how a lot of people will look at it. What's curious about this current stage of gold's rally is I actually think that a strong US dollar is contributing to the strength in gold prices, right? One of my core beliefs is that we can learn a lot more about anomalies from anomalies in markets than we can from what markets are actually supposed to do. So if you think about gold's epic performance over the last year, it's actually quite of an anomaly, right? Gold's rallied despite US dollar strength in periods when the US rates were rising as well. Gold's actually only ever had this good of a performance alongside a strong performance in the S&P 500 twice in history. The first time would have been 1933 when the US government decided to revalue gold, and the second time would have been 2009 during an epic or the largest round of quantitative easing at the time. The gold has also never had this strong of a run outside of a US dollar bear market, right? So clearly the strength in gold prices is a market anomaly, and I think it's telling something for those who are willing to listen. What it's actually telling us is that gold has taken on a new role. The strength in the US dollar is acute enough to catalyze buying activity in gold as a currency depreciation hedge, particularly out of Asia. And this is a trend that we've seen developed over the last 2 years and has come back into the fore as of January of this year.
So current investors in Asia are concerned about the weakness of their own currencies against the greenback?
That's right. And one of the ways that they can protect themselves from that is by buying gold.
And then I'm just trying to think what else. We do have a distortion in the market, though, don't we? We've heard these reports of vast amounts of gold being shipped across the Atlantic because hedge funds and the like in the US want to have gold in case Trump puts tariffs on it.
Yeah, that's right. I think, you know, we've spoken about this before, Andy. It's an epic distortion in commodities markets that is currently hiding behind the rise in gold prices. Really, it's not necessarily all that relevant to gold prices per se, but under the hood, the return that you can earn from moving physical gold from London into the US has been abnormally large over the last months. That's now showing some signs of easing for gold in particular, but not necessarily so for silver and other precious metals.
Now, the melt-up in gold, as you call it, and it really has been that over the past few weeks, you reckon we're not seeing big speculative inflows into gold?
So here's the interesting part there, right? I think the setup in gold we can summarize as heads I win, tails you lose. So in moments of time when the US dollar is appreciating, when US rates are rising, the appetite for gold is coming from Asia as a currency depreciation hedge. And in moments of time when US rates are declining, the US dollar is declining, macro funds, these are overwhelmingly Western, they look at gold in the traditional sense of a US dollar should be, a lower US dollar should be good for gold. And that is the cohort that buys gold conversely. So it's a pretty extraordinary setup in gold. It's quite rare, doesn't last for necessarily very long. But for as long as this setup persists, it's a very strong context for gold.
What about silver? Is it still a poor relation to gold?
You know, increasingly less so. Silver has a really unique story. We're heading into its fifth consecutive year of a structural deficit. That deficit is really unprecedented in terms of its magnitude of the supply-demand imbalance that's been created by the demand boom, which has ultimately been associated with increased solar capacity around the world. Mm-hmm. Now, the setup in silver is different because we're actually, in our view, transitioning away from a demand boom and into a liquidity crisis. The pull of metal from London into the US has been so dramatic that it's draining the world's largest bullion vaulting system to such an extent that it's actually disturbing day-to-day trading activity in physical markets. So London is trading extremely tight. We think it can get even tighter, and ultimately, flat prices in silver need to rise in order to incentivize metal to come back into London from unconventional sources.
What would they be? Just long-term holders of silver for whatever reason?
Yeah, historically, there's basically a few different groups that can come into play to resolve these types of imbalances. One of which is private vaults. You have a large amount of silver that is just stored away in private vaults. These might be owned by family offices, private investors, and so on and so forth. And if the price is right, they might be willing to resupply the market with that silver. Another such venue is ETFs. ETFs also hold a significant amount of silver and can potentially be tapped if the price is right in order to resolve this imbalance. And finally, mom and pops that own silverware. Presumably it can be remelted into a form that can be delivered back on exchanges. We haven't seen any sign that any of these pressure release valves has been tapped. And what that tells us is simply that we're not really at the strike price necessary for this to come in.
I'm wary of this because we do, over the years, we hear about a so-called silver squeeze or the risk of that, and that people who shorted silver will get caught out and they'll have to buy it back at ever higher prices. Do you think there is a prospect of that? I mean, the silver market is quite small.
Well, what we've been calling it is the silver squeeze you can buy into. Okay. And I think the critical difference there is that this isn't, a conspiracy theory relating to short contracts that need to be delivered into. The movement of metal is simply a function of arbitrage, but it's inadvertently draining the world's largest bullion vaulting system. There is, according to our estimates, just around 250 million ounces remaining that are freely available for purchase in London as of January. Every day, that number is grinding lower. But guess what? Around 250 million ounces of silver trades in spot London markets every single day on average. And so what that tells you is the more we drain it, the more that's going to put pressure on the silver market. And there is a strong academic relationship that suggests that lower inventories in a given commodity are correlated with higher volatility in that given commodity. That's what we're looking at here, and that's what we're calling the silver squeeze you can buy into.
Daniel, this is a slightly off topic here. India, Bloomberg has a look at the vast holdings among Indian households of gold. Apparently, 25,000 tons are held in India. People see it as their key to their future retirement security, and they've been doing it for perhaps millennia. I wonder, with these record high gold prices, will there be a wealth effect in India? Or I know we're speculating here, but obviously they must be happy to see gold near record highs.
Yeah, it's interesting, right? And I think in large parts of Asia, precious metals, whether they're in the form of jewelry or otherwise, tend to actually correlate quite well with the underlying price. So people could presumably resell that. The question really is, can it come in a form that is acceptable for either the London Exchange or the US Exchange? And historically, by the way, in the last bull market in silver, I believe in 2009, silver remelt from India was significant enough of a line item that you had to kind of split it out in your balance sheet for the commodity. So it could presumably come back to light, but we just have not seen any sign of that yet.
Daniel, thanks very much. It's always great hearing from you.
Thank you so much, Andy.
Daniel Gali.
A few final insightful posts regarding the ongoing valuation of gold versus other competing asset classes around the world. The Australian housing bubble is beginning to give way to gold in real value terms. Look at the top right chart here. That's the average Australian house price divided by gold, which has recently fell like a stone. Long-term targets for bullion versus homes down under are in the lower bound. All these double lines on the gold and silver chart bottom right. Similar but slower is the story United States stateside, where rising housing prices and high mortgage rates have pushed the median age of homeowners to a record high of 56 years old, up from 30 years of age back in 1981. Now, speaking of the early 1980s, those levels remain long-term target lines for average U.S. house costs relative to gold and silver respectively. Look hard, again, top right chart here. Gold is falling. Eventually, silver follows gold in bullion bull markets in future mania phases. Now, finally, to close, I want to remind you just how early or middle innings we are likely in this ongoing bullion bull market. With a look back to 1980, when early in the year, on January 21st, 1980, the gold futures price per ounce hit a then all-time nominal price high of $875 an ounce. That is in way more powerful full fiat US dollars at the time. Now, no, rumors of the world's demise when gold goes manic and accounts for profligate fiat currency bubbles, those rumors remain exaggerated. The world didn't end. You see, back then, the same alleged amount of official gold reserves held by the United States that we currently allegedly still hold now, well, that 8,133.5 tons of gold was briefly valued at 1/4 or 25% of our then outstanding U.S. debt at the time, $863 billion. Cut to today's $36.2 trillion debt and growing, with $150 trillion or more in unfunded liabilities increasingly coming due this decade and for the decades to come. Well, for history to rhyme in time, we're talking about a gold mania price spike today to $34,630 an ounce at the moment. And as our U.S. debt keeps rising, that equivalent 25% U.S. official gold reserves to debt coverage spike number, well, it rises to silly levels that perhaps Bitcoin psychologically prepared the world to one day witness in gold globally. That's going to be all for our weekly SD Bullion Market Update. As always, to you out there, take good care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.